Welcome to the Deep Dive. This is where we take a whole stack of information articles, research notes, and really try to pull out the key insights for you. It's about getting you properly informed fast. And today, we're diving into something pretty interesting, maybe a bit provocative, actually. The latest weekly newsletter from the Macro Butler. It's got this bold title, Deutschland unter allen.
Yeah, that title really jumps out, doesn't it? Germany beneath all. It's a direct flip of the old Deutschland über alles. Germany above all else.
Exactly. It signals right away a pretty bleak view of where Germany stands now, according to this source anyway. So our mission today is basically to pull back the curtain on the economic and political picture the Macro Butler is painting here for Germany. And, what that might mean for Europe, maybe even global markets. We'll unpack their main arguments, some surprising claims, too, just to help you grasp what the source thinks is really going on. And look, some of these claims are definitely controversial. So just to be clear, we're exploring their perspective, the arguments they make. We're not endorsing it, just trying to understand the source material itself.
Right. It's about sifting through the layers, isn't it? The economic data they use, the historical context, the geopolitical commentary. And what's really striking, I think, is how it pushes back against a lot of the standard narratives you hear, especially about Europe's stability and, well, Germany's role in all that. We'll look at the specific points the Macro Butler raises, try to connect the dots for you, see the picture they're trying to create.
Okay, so the newsletter kicks off by saying, everyone's watching U.S. politics right now. It mentions Donald Copperfield. That's its name for Trump.
Hey, yeah, implying it's all a smoke and mirrors routine.
Right. But it quickly pivots away from that, wants us to look at the bigger global economic scene. And here's where it lays out some numbers, gives this snapshot of global GDP. Says the U.S. has about, 24-25%?
Yeah, China second, 17-18%. Then Japan, Germany, India are all clustered around 3-5% each.
And then the UK, France, Brazil, Italy, Canada, smaller slices, 1.53% each. It uses this to kind of set the stage, the broader battlefield, as it calls it.
So connecting that to the bigger picture, the source argues that, okay, maybe China keeps Washington's war machine buzzing, as it puts it. But the real threat to stability isn't what the media screams about.
Okay, so if it's not the usual headlines, what does the source see as the deeper rot in Europe? It dismisses hype about Bitcoin or the euro challenging the dollar.
Well, it points fingers pretty directly. It talks about chronic budget deficits, open-door immigration madness, and a DEI Malthusian cocktail pushed by unelected bureaucrats and lame duck politicians. That's quite a phrase.
It is. That DEI Malthusian cocktail. The source seems to be suggesting, a mix of diversity, equity, inclusion policies that it thinks are creating an unsustainable burden, kind of like Malthus worrying about population growth. It's a very specific, critical take from the Macro Butler.
Definitely a specific viewpoint. And then it dismisses the idea of a Russian invasion threat as laughable.
Yeah, argues Russia has zero interest in conquering a place it sees as drowning in red tape, bloated wealth, and demographic decay, plus no real resources.
And that gives that really strong claim.
The one about the real conquest already happened from within by the illegal aliens who were used as a Trojan horse by reckless Keynesian politicians. It's certainly a controversial statement.
Very. Okay, so that's the global backdrop, according to the Macro Butler. Pretty grim.
So how does this all connect back to Germany specifically? The newsletter calls it Europe's engine, right? Usually about 25% of EU GDP.
Right. The source lays out Germany's traditional powerhouse model. It says it's based on this old, centuries-old mercantilist strategy. Basically combining efficient manufacturing with cheap Russian energy. That's what generated real wealth, it claims.
But that's a shift.
Yeah. Then it argues that by blindly following Washington's Russia hoax, Berlin committed strategic suicide. That's the source's interpretation. And it zeroes in on the sabotage of Nord Stream as the symbol of the willful destruction of Germany's competitive edge.
Calling it Germany amputating its economic leg. Wow.
Pretty graphic language.
And the impact. The source lays it out pretty clearly. That negative 0.2% GDP contraction in 2023 made Germany the worst performing major advanced economy on Earth.
It mentions that little uptick, the 0.2% growth in Q1 2024, but dismisses it as just delaying deeper structural decay. Points out Q4 2023 was revised down even further to negative 0.5%.
And the argument is that the sanctions just became self-inflicted wounds.
Exactly, leading to skyrocketing energy prices, more bureaucratic red tape, a shrinking skilled labor pool, and this rising tide of unskilled, unintegrated migrants. all driving costs up, productivity down, stalling growth.
Right.
And ECB rate hikes didn't help either, according to the source.
So looking forward, the newsletter predicts more pain. It says Germany is bracing for another wave of corporate collapses well into 2025 and 2026.
Yeah, and it gives some historical context for bankruptcies, which I thought was interesting. They peaked in 2003 after reform, spiked again after '08, then went down until 2021.
Right, and during COVID.
They magically disappeared, it says, thanks to state-sponsored life support. But the bill came due.
So the numbers started jumping again.
Big time. Up 16.7% in 2022, 19% in 2023, and then a jaw-dropping 26.6% surge in Q1 2024.
Wow.
And the source stresses these are now well above pre-pandemic levels, like 15.7% higher than Q1 2019, flashing red for 2025 and beyond, it says.
And the implication isn't just for Germany, is it? The newsletter warns this is a systemic risk.
Exactly. The argument is if the Eurozone's economic anchor keeps sinking, well, confidence in the whole project could go down with it.
Okay, so the economy's struggling, bankruptcies are up. What about Germany's reputation for fiscal prudence? The source claims that's cracking too, even the safe haven bonds.
Yeah, it explains that prudence was rooted in history, right? That post-Weimar terror of inflation. But it argues this current shift to deficit spending isn't some planned Keynesian boost. It's seen as a desperate maneuver.
In response to what?
Twin crises, it says, economic decay, and this growing appetite for confrontation with Russia.
So the source sees Germany sailing full speed toward a fiscal cliff.
Pretty much. Predicts no recovery in sight, only stagnation well into 2028. And it uses the term stagflation, trapped with shrinking growth, persistent inflation, and clueless leadership, in its words.
It's pretty scathing. It blames the blunders of COVID lockdowns, the costly climate agenda, and blind allegiance to U.S. sanctions, including being silent on Nord Stream.
And says all the attempts to patch things up, subsidies, price caps, handouts, green spending, none of it is working.
So what does that mean for the famous Schwarzenegger, the balanced budget rule?
Well, the source calls the emergency overrides of the debt brake in 2022 and 2023 a full-blown capitulation. And it says that the fact they're even debating rewriting the rules signals the end of Germany's fiscal conservatism.
And the knock-on effect.
The argument is, as Germany slides into fiscal mismanagement and political delusion, confidence in the euro itself erodes too, because confidence is the real metric and it's bleeding.
Okay, let's shift gears slightly. The newsletter also talks about Germany's rearmament, calls it a historic shift.
Yeah, driven by NATO, it says. But Germany's juggling this with social spending, climate fantasies, and war ambitions. And then comes that line, you can't fund 3 crusades at once.
So how is Germany trying to fund the rearmament, according to the source?
Well, it pledged to hit NATO's 2% GDP target for defense, and it launched that huge EUR 100 billion Bundeswehr fund.
The one that was borrowed off the books? What does that mean exactly?
It means it was set up as a special fund outside the regular budget. This let them get around Germany's constitutional Schuldenbremse, the debt brake, specifically for defense spending. But the newsletter says that fund is nearly spent already.
And it mentions Friedrich Merz, calls him the new chancellor-in-chief.
Yeah, describes him as publicly defending the debt brake, but quietly engineering ways to sidestep it, pushing shadow budgets and special funds, basically. It even cites a supposed March 2025 deal to exclude defense and security from debt limits and set up a massive EUR 500 billion infrastructure fund.
And the source also notes Merz threatened to send NATO missiles to Zelensky.
It does. And then makes another really strong claim that Germany needs war as a cover for fiscal collapse.
Wow.
Yeah, arguing that Europe marches to NATO's war drum, blaming Russia. The conclusion is pretty stark.
Yeah.
Germany isn't just rearming, it's unraveling. And with it, the fragile foundation of the entire EU.
There's an interesting irony the newsletter points out next, isn't there, about German holdings of U.S. debt.
Yeah, it is ironic. Germany, the supposed home of fiscal virtue, holds around $200 billion in U.S. treasuries. Makes it a top 10 foreign holder.
Why would that be, according to the source?
Simple reasons, really. Treasuries offer better yields than bonds, more liquidity than euros, and less drama than Brussels. Plus, they look safer with war drums pounding across the continent, as the source puts it.
And this ties into gold as well.
It does. The source calls Germany a model Keynesian pupil for having ditched gold in favor of IOUs, meaning debt instruments like treasuries. It says Germany's been shrinking its gold reserves for 25 years, now has less than 108 million ounces, trailing those gold-hoarding nations in the global south. Raises questions about long-term strategy, doesn't it?
It certainly does. Okay, so then the newsletter zooms out to the euro itself.
Right, and it argues the Eurozone project was never about economics. It was about consolidating power, the end goal, a common government, the United States of Europe.
Claims Helmut Kohl skipped the vote on the euro.
Yeah, and that the currency was always a fantasy without merging debts. A problem, it says, that's still waiting to be fixed 26 years later.
And it uses an analogy for the EU debt situation. Something about a ship.
Yeah, picking the weakest plank on a rotting ship. It highlights Greece's debt to GDP, 173%, and Italy's at 143%.
Calling Italy the real elephant in the room.
Because of the sheer size of its debt, 2.9 trillion, and the political chaos. The point is, without debt consolidation, each country still carries its own baggage, just under one flag and with a confused central bank.
Okay, so given all that, what does the source predict for the euro versus the dollar exchange rate? It seems pretty dismissive of the idea the euro could overtake the dollar.
Very dismissive. Calls it fake news hype. It lays out a few key drivers for its view. First, monetary policy. It expects the ECB to keep cutting rates faster than the Fed, which might do one last cut. That narrows the gap, weakening the euro, it thinks.
Okay, well,
Yield spread. Simple idea. When U.S. 10-year bonds pay more than German bonds, money flows to the dollar, weakening the euro.
makes sense. And the third driver?
Economic surprise indexes. Basically, if the U.S. handles upcoming tariff tantrums better than the Eurozone, or if war heats up in Eastern Europe or the Middle East, hitting Europe harder,
Yeah.
then the USD just looks cleaner.
Cleaner. Like the least dirty shirt analogy it uses.
Exactly. Exchange rates between fiat currencies are just about picking the least dirty shirt in the laundry basket. That's the quote.
So if that's the outlook, what's the investment advice? It sounds pretty blunt.
Extremely blunt. It says steer clear of Eurozone assets like they're contagious. And if you live there, start packing. Because sticking around might be the worst investment of your life. It even warns about potential capital controls down the line.
Wow. Okay, so how does the newsletter wrap all this up? What's the final advice for navigating this chaos cycle, as it calls it?
Yeah, it says volatility isn't the glitch, it's the operating system now. The Goldilocks era is dead, and the new playbook, the age of gold in lots.
Gold in lots. What does that mean, practical terms?
Well, the key takeaways are about shifting focus. It says investors should prioritize return of capital rather than the return on capital. Preservation first. And it hammers home the point about precious metals. Physical gold and silver remain the only reliable hedges against reckless and untrustworthy governments and bankers. Calls them an eternal hedge against collective stupidity.
And government power.
Right. It dismisses long-dated U.S. treasuries and bonds as uninvestable, returnless assets. Recommends short-term U.S. stuff like T-bills for cash.
What about stocks?
It suggests focusing on lean, low-debt, high cash flow champions, companies that can do well even with reshoring, trade wars, and more defense spending.
So the core message is really about safety and resilience in a messy world.
Exactly. Preservation and finding things that are robust or even benefit from chaos.
The source also says the real enemy isn't next door, it's the warmongers pulling the strings. And it draws a sharp contrast between gold and crypto.
It does. It says physical gold offers something those crypto evangelists will never grasp, genuine autonomy. Not just from the dollar, but from all fiat currencies heading toward central control.
Calling gold the original guardian against volatility and control. Why?
Because it argues, gold is the only anti-fragile asset with no counterparty risks.
Anti-fragile, meaning it actually gets stronger from shocks and chaos. And no counterparty risk means you're not relying on someone else to make good on a promise.
Precisely. That's the concept it's borrowing there. It doesn't just survive chaos. It potentially thrives,
Yeah.
and it exists independently.
So wrapping this up, what does this all mean for you, our listener? We've really dug into the Macro Butler's Deutschland, Unter newsletter here, unpacked its pretty bold claims about Germany's economy, the euro, the whole geopolitical picture it paints.
And it's fascinating, isn't it, how the source frames it? That is, German dominance, in its view, trickles into German decadence. That old phrase, Deutschland über alles flips. It becomes Deutschland unter allen, Germany, beneath them all, marking the twilight of a nation, as the source dramatically puts it. It's quite a narrative arc it constructs.
Definitely a strong narrative, and it leaves us with some heavy quotes to think about, doesn't it? Drawing on Orwell and Cicero.
Yeah, the Orwell quote, "The war is not meant to be won, it is meant to be continuous. Its object is not victory, but to keep the very structure of society intact."
And Cicero. The closer the collapse of the empire, the crazier its laws. These are not exactly comforting thoughts.
No, they're meant to be provocative, I think.
Yeah.
And it leads to the final suggestion from the newsletter, that in times like these, the wisest move, investor or not, is to seek refuge where state control is weakest and resilience thrives.
And that cryptic hint, think less Brussels or DC, more Zumia.
Right, Zomia. That's that anthropological idea about those highland regions in Asia where people historically managed to stay outside of state control, live more autonomously. It's a powerful final image suggesting, well, maybe looking for resilience outside the main systems.
That is certainly something to mull over. We hope this deep dive gave you a clearer, maybe more nuanced view of the specific arguments the Macro Butler presented in this piece. Until next time, keep that curiosity burning.